From our studios in Scottsdale, Arizona, welcome back to Retirement News Online. You can find us at retirementnewsonline.com. Most investors think that risk is just the market going up and down, but true risk is far more complex, especially for people nearing or in retirement. Now, a skilled advisor helps clients understand the different types of risk they face and builds a plan that protects their lifestyle, not just their portfolio. And joining me is one of those skilled advisors, Marc Noonan with Clover Wealth Partners in Louisville, Kentucky. Marc, thanks for taking the time to talk with us today. So how do you help clients understand the difference between market volatility, which is not a problem of the market, it's a tool that we use to make money, and long-term risk to their retirement income? I think there's some similarities but some differences there.
Risk is relative.
Yeah.
Per the person, per the age. A theoretical rule of thumb is at age 60, 60% of my money is invested in the market, 40% is conservative. So every year we shift and keep up with 61, 62, 63. So in retirement, we're obviously moving more into the conservative direction. Risk, the greater the risk, the greater the reward. Now, that means that I'm going to get returns here, but I'm also going to get losses here. So we take a moderate approach when we get into retirement, and that lets me run in the middle, and my highs are here and my lows are here, which makes it easier to draw money, because drawing money in a high-risk arena is not a good idea.
So when somebody's younger and they set their risk tolerance, which is sort of an emotional thing, it really doesn't matter for them because they have time to make up for things if the market goes sideways. But as you get closer to retirement, we have to do a couple of things. How do you still protect assets, but then looking at how long people are living and how long they may be in retirement, 20, 30, maybe even 40 years or more, how do you still provide growth at the same time, because they're kind of mutually exclusive?
So the growth aspect we look at in 10-year windows. So if I'm 30, I'm very, very aggressive. 40, aggressive. 50, I'm pulling back. Towards the end of that 50 to 60-year range, I'm pulling back even more, because when I draw money, I'd like to make it as tame as possible. The investment environment has changed significantly, as it always does, and now offers protections on my money. If I put in $1 into a certain position, it may say the first 30% of it, if you're down anywhere between 1 and 30%, you lose nothing. Now after that, you'll start to experience a loss. So we spread our risk and our drawing power across these type investments, keeping our principal dollar in a more protected position.
So you're doing this with things that aren't stocks. I mean, you have to use some other kind of tools, right?
They actually have, now stocks are stocks. They're outright ownership in an individual company. But a thing called an ETF, electronically traded fund, is very, very similar to a stock and very, very similar to a mutual fund. It's comprised of the same type investment, maybe 30, 40, 50 of them. Those are where we find these buffers and take care of our money.
So let's talk about sequence of returns risk, which is the idea that two people with the same amount of assets, the same amount of risk, the same amount of return, they take income at different times. For example, you started taking income in 2001, right after we had obviously 9/11 and the market retreats. And then you have somebody who starts taking income, say in 2010, after the mortgage crisis, where we're on a 10-year bull. If you take income at the wrong time, when the market is retreating in the early part of your retirement, that can actually mess up the entire process. How do you avoid that? How do you manage taking timing out of the market?
The first thing to understand is, how much money do I need? So we establish a budget. How much does it cost for me to get from the 1st of the month to the 30th of the month, the January 1st to December 31st? And we focus on that dollar amount, not considerably more, which is what everybody wants in retirement. And then we monitor the environment. We do have to make changes as the market worsens. The dollar draw may not change, but the investment position could change to be more protective. So it's fluid. And we always bear out what the market is allowing.
And so someone working with you, the idea is that you're going to help manage their assets unemotionally, because emotion gets in the way sometimes. So we just had, let's go back to April when the market dumped 3,000 points at the opening bell. Now, a lot of people would knee-jerk and pull out and maybe do that at a time where they're going to miss the rebound. How do you coach somebody in that situation when they've seen a dramatic drop in the market? How do you calm them down and do what you need to do?
The numbers that are involved with the market are pretty sizable. So I tell them, don't look at the market. Let's look at your account. And at that particular point in time, accounts were down 3%, 4%, which is insignificant. Now, it is a dollar amount that's uncomfortable, but in how we manage the money, it's more in tune with being insignificant. Keep your head down, let's go forward. And as we saw following that, it came back pretty quickly.
That's Marc Noonan with Clover Wealth Partners in Louisville, Kentucky. And this is Retirement News Online. Thanks for watching.